Hello and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. Well, our contest this year to predict the value of Bitcoin and the value of gold in a relative sense by the end of this year, so all of 2025, has certainly been interesting. Volatility is still the name of the game. Much has happened within the period. And much has happened even in recent days since the last update. Bitcoin is up 8.4% year to date as of midweek, and gold is up 61% year to date. So that puts the target winning number at less than 0.15. So it's a landslide victory so far this year for gold. Now, given the volatility we've seen so far this year, a great deal could change by the end of 2025, so stay tuned. This week's episode will feature 4 different podcast interviews I've done in recent days. I was happy to find out that all of the hosts of these shows hold the Austrian school in high regard. In addition to questions about the Austrian school and the economy in general, there were several questions about recent episodes of the Minor Issues podcast and my analysis of the market for precious metals. Now, the interviews took place during the sharp contraction in recent precious metal prices. So I think you'll find the discussion illuminating. Now, the interviews are about 30 minutes each, and given that there are 4 of them, you might want to increase the playback speed. Next week's episode is planned to show how the Austrian analysis provides an integrated and comprehensive analysis to all the major economic problems in the U.S. and world economy, and some of the so-called bright spots. In contrast, most economic commentary deals with issues separately, siloed, outside of a theoretical framework, with often a strong media bias. As always, your comments, your questions, and your suggestions on the YouTube platform section of this show are very much appreciated. Thank you for listening.
Hey, everybody, this is Rob Keens with the Freedom Report, and I have a very special first-time guest on the program. It is Dr. Mark Thornton, who is a senior fellow at the Mises Institute. He's the Peter Sinelletti Chair in Austrian Economics from 2021 to 2023. He hosts a couple of podcasts of his own and is a book review editor of the Quarterly Journal of Austrian Economics. Dr. Thornton, welcome to the program.
Rob, it's great to be on the Freedom Report. Thank you for having me.
So, Dr. Thornton, I guess you said I could call you Mark, so I'll call you Mark. So we were chatting before the interview and just talking a little bit briefly about our own backgrounds. And you mentioned something very interesting. I said, the way I came to Austrian economics was originally after I got laid off from Ernst & Young in 2009, and then I started studying the economy, figure out what was going on, went to work for a Forex company, had seen the mortgage market from the inside, and I knew something was wrong. And I was like, the economics I was taught in my business degree was not correct, and the accounting was not correct. Something was off. And I read Creature from Jekyll Island, and then I started reading books at the Mises Institute, and I got hooked on Austrian economics. Can you explain what led you into Austrian economics as a field of study and why that became such an important part of what you do?
Well, I grew up in the 1970s, and, the economy was in a quagmire of stagflation, of high inflation and high unemployment. And the Keynesian models that I was still being taught in college were, couldn't explain any of that. And so naturally, I was looking, as an economics major, I was looking for an alternative view. And I found the Austrian school, Ludwig von Mises, Friedrich von Hayek, Murray Rothbard, all on my own. And I took all these courses in college, and never once were any of these people mentioned. Mm-hmm. And so I decided to go to graduate school and learn more about it, only to find that they really didn't teach any Austrian economics in graduate school, but I was fortunate that the Mises Institute came to Auburn University right after I showed up. So, the Austrian school, Ludwig von Mises brought it to the United States during World War II when he was chased out of Europe by Hitler. And, it dates back into the old classical school where economic reasoning is deductive, it's logical, it's based on human action, human motivations. And the Austrians are the ones that created things like supply and demand and opportunity cost, all of the things at the beginning of an economics course which seem to make sense to everybody before they get off into Keynesian monetarism and other diversions, and even price controls. You see early on in an economics course, Ludwig von Mises was a socialist when he was young, and he was given a research project to study rent control in Vienna and found out that it just didn't work. And so he started digging deeper and he found the existing Austrian school at the University of Vienna. And he made some wonderful contributions, The Theory of Money and Credit, the book on socialism, which debunked socialism in 1920. And then, of course, he went on to make many, many more contributions, and that all fell into my lap. And so it was a very fortunate thing that happened to me many years ago, and I'm still living the dream.
Yeah, it really changed the way that I looked at economics. When I had my business school degree at University of Texas at Dallas, it was a hybrid degree, a tech and a business one called it Management Information Systems. But I took accounting and finance classes, and I remember getting into economics, and they were talking about supply and demand, micro and macro. And it was funny, we would be in class and we would take a current event and it didn't match up with what they were teaching. And I knew back then, something's a little off, but really when it came to the Great Recession, you could tell that the printing policies, the way that the Fed had been intervening in the market, the direction of the economy wasn't stable. And at that point, I had sort of a disconnect. I was like, wait a minute, this is what I've always been taught. I've been a business student. I've been in business for a long time. I was working for the Big Four, made all these assumptions that were wrong. It kind of turned it on its head. And the way I saw that was through the failure of the mortgage market and working inside on a project for EY. Our client was Morgan Stanley. They bought 52,000 loans from Novastar. They were collapsing. They brought us on, a bunch of us accountants and technical people, to say, come help us fix this. It was a weird project, not my typical auditing project, but we got to see the problems from the inside. And I began to look at this and say, this is insanity. The way that they were issuing these loans made no sense whatsoever. And all of a sudden, I began to see this bubble. And I knew at that point there were problems. And then I got, my famous stories, I got laid off in February 1st, the height of the crisis, and went to work for a Forex company, and then looked at the currency markets and said, okay, this is insanity. This makes no sense. And the funny thing is, I could see on the charts, because I was supporting our client, so I'd have to explain to them what's going on. And I would see the charts, and you would see these big interventions coming in the Forex market, and you knew it couldn't be an individual player. So at that point, I knew that the US government was intervening in markets. And since then, I've talked about how they intervene in the gold markets, which we'll get to. That's kind of how I came to it. I came through experientially. Sounds like you may have also. I was reading one of your recent stories on tariffs, and you were talking about how tariffs are really not the answer. Could you talk about tariffs a little bit and why tariffs can be dangerous in an economy and some of this distortive effects that they have on the economy?
Well, tariffs is actually one of those things that almost all economists agree that it's bad for an economy. It's a burden on the domestic people, Americans, and it's also a burden on foreigners. And it really hurts consumers, and it hurts our ability to produce. It doesn't really provide any rational benefits. Now, of course, there's cronies that are going to be able to take advantage of the tariff protectionism. So if we put on tariffs, it's going to protect inefficient local domestic producers. But by and large, it's going to hurt people across the board. American consumers are going to be hurt, and American producers, entrepreneurs, workers are going to be hurt because they're going to have to pay more for their inputs. So it actually makes American suppliers less efficient and less competitive. And it gets worse from there because, tariffs are something that can get out of control. Because if we enact tariffs, other countries will enact retaliatory tariffs against Americans. And you get into a trade war where everybody is upping the ante, so to speak, on tariff rates. And so you're continually throwing greater and greater burdens on your domestic consumers, your domestic producers, and on foreigners. And so this is, there's nothing good about tariffs. And eventually, these tariffs become, they develop bad relations between countries. And so because of President, Trump's tariffs, we're losing friends in Canada and in Mexico. We're losing friends in Europe. And we're confronting China. There's a lot of things that can be done to address those issues that don't involve tariffs and don't create tensions between countries, because history reveals that tariffs are just one step away from actual confrontation, actual military intervention on the part of players. And we see people taking up sides, and we see the United States losing friends. Like we put this big tariff on India because it was accepting Russian oil. We've been trying for decades and decades and decades to develop good relations with India and to pull them away from communist China and communist in Russia. And now we've just simply thrown them back into that Chinese Russian orbit and away from the United States. So it degenerates in terms of foreign relations as well as just basic economic efficiency and it's basically a harm to our standard of living.
Yeah, and I wanted to transition to another big talking point more here at home with regards to Austrian economics versus Keynesian economics that most of us were taught in school, and it's the subject of taxes. Taxes, in my opinion, can be very damaging to economy because they will reduce the amount at which consumers can spend and can overall reduce the output of the economy. And often the monies are given to a government which can be the least efficient option in implementing whatever program needs to be implemented, whether it be social programs, even building roads, things like that. Can you talk a little bit about your view on taxes, whether they're generally a good or bad thing? Is it good to have them at all? Is there like a point at which they start to become negative to the economy, or is it good to have them at all, or would it be good to completely remove them?
Yeah, I'm against all taxation on libertarian grounds and on economic grounds. All taxes destroy production, destroy capital, and reduce the standard of living. So they're across the board negative. Now, Americans, or people living in big countries, they don't feel like they can do very much to avoid taxes. But if we look at like the situation in the United Kingdom right now, where they're threatening to raise taxes in order to continue to finance government bureaucracies and welfare and increase military spending and all sorts of things that don't add anything productively into the economy. Well, it's undermining business. It's undermining what's left of industry in the UK, and it's quickly leading people to actually just pull up the roots and leave the United Kingdom. So people have been leaving, are preparing to leave, And it's the wealthiest people who are leaving, and the people who pay the most taxes. And so this is a negative, reinforcing, circular system that it just reduces the overall economy, and it's going to reduce the overall standard of living. So if you take it to a smaller country where people are more mobile, you see that people are running away from those taxes, and it's precisely the most productive people and the people who pay the most taxes who are the ones that are most likely going to flee away. And so, yeah, I would definitely put the brakes on all ideas about increased taxation. And what we really need is more tax cuts. President Trump passed what was called a tax cut, but it was really just locking in place for a few more years the tax cuts that were already on the books. So we need to think about cutting government, cutting the deficit, and cutting taxes even further to stimulate the economy, to encourage wealth and capital production, and to increase the standard of living.
Yeah, I wanted to switch over to fiscal policy here for a moment, because taxation is a way in which the government takes a portion of the money supply out of the hands of Americans and reallocates it to government. But really, maybe looking at an even bigger part of the problem, and another thing that we created in the early 1900s was the Fed. I know you've written a lot about the Fed. The Fed, the value of our dollar has decreased by 98% since 1913. That's a popular statistic, and often you'll see graphics in social media about how the dollar value has gone down. Of course, gold is reflecting that now as the prices rise. But recent decisions by the Fed, because of the unemployment issue, to end their quantitative tightening program that Powell's had in place the last couple of years, where he raised interest rates, and where they, as issuances of debt that they held expired, they weren't buying new ones. So it was like the slow passive roll off of debt holdings by the Fed. It looks like they're going into more of a quantitative easing. They've lowered interest rates now down to the 3.75% to 4% rate, almost a full percentage below the peak during his tenure. And with them ending quantitative tightening, I'm assuming that at some point they're going to quantitative ease. They're actually going to buy if we continue to have problems in the economy. At this point in time, with over $38 trillion in debt, with a declining dollar that for the first time, in my lifetime is no longer, I don't think, the reserve currency, because we're now below 50% of foreign held reserves. What is that signal? Is that signaling the end of this stage of the dollar era? Do you think bigger troubles are coming? And what do you think about the Fed's policy recently?
Well, I mean, definitely, I'm in terms of the macroeconomy, I'm definitely worried about the current state. I mean,
Mm.
we have runaway government spending, we have runaway government deficits, and we have a $38 trillion national debt. It only took a couple of months to go from 37 to $38 trillion in debt. And then, of course, there's the unfunded liabilities of the federal government in terms of Social Security, Medicaid, Medicare, and pensions, and et cetera. So we're in a very unbalanced fiscal situation in the U.S. And of course, that necessitates, they can't really raise taxes fundamentally. They're not cutting spending at all. That Elon's program was really a mirage, a fake. As much as we cheered it on, it really didn't put a dent in anything.
Mm.
And so, that means in all likelihood that the Fed is going to monetize that debt, that they're going to have to buy up a good portion of that and monetize it, injecting money into the economy and creating price inflation down the road. There's really, that's the way it looks. I mean, and the Fed has one thing, it's printing money. Of course, they reduce interest rates, they buy government bonds, they just make up money out of thin air in order to pay for those bonds. And that money, of course, benefits the government, it benefits the big banks, it benefits the power elites tremendously. But as it trickles through the economy and is spent by these initial money grabbers, of course, it means higher prices for you and me and everybody out there. And you know, we've got to expect that that's what's coming down the line. I've been expecting, you know, they've been tailing off this quantitative tightening business where they're selling part of their balance sheet into the marketplace. That never really got very far. And they began, you know, curtailing that program a long time ago. Now they stopped releasing that debt into the economy. And I have every belief in the world that they're going to start buying up more assets, monetizing more government debt, maybe mortgage-backed securities. You know, they're very worried about the long end of the curve, the 30-year government bond, the 30-year mortgages, things of that nature. You know, on the short end of the curve, of course, Obama, Biden, and Trump one and Trump two are appointing easy money doves to the Federal Reserve rate making body. So that reinforces our expectations. You know, if the president is calling for lower interest rates and the last several presidents have been appointing people who are amicable to lower rates, then that's what we've got to expect. And that means they're going to be buying up, they're going to be quantitative easing, they're going to be buying up a lot of, you know, government debt across the curve. And so that means more inflation, price inflation in our future. And ultimately, of course, that's going to harm our economy, no doubt. But I think that's the general direction. And there's nothing that they've said, there's nothing that they've done that would lead us to believe that they are somehow in the process of reforming the way they do things in Washington, D.C., in the Congress, the president, or the Fed itself.
Yeah, something interesting that you mentioned at the beginning was that the big banks benefit from the monetary creation. And I wondered if you would talk about something called the Cantillon Effect, in which the money as it's produced benefits the first person that gets it more than everybody else. And then eventually, as money enters society, you get inflation. Has that been something that you've studied as well?
Oh, yeah, I've done most of my research in recent years on the economist Richard Cantillon,
Mm-hmm.
who wrote a manuscript in 1730 in the aftermath of the South Sea and Mississippi bubble, in which he became a a millionaire back then, and was one of the richest people in the world. But he was involved in the Mississippi bubble. He was an insider, and he wrote a manuscript where he basically developed economic theory. And he explained everything from price formation and supply and demand, trade policies, currency policies, and the business cycle, and the role of the national bank, is what it was called back then. And he said that it's all a game and it's going to come home to roost. And basically, his idea, and he looked at several different cases, but in our environment, basically, the national bank is going to be injecting money into the economy, and the people who get the money first, they're going to benefit. Typically, they've got the money before prices go up, or they get the credit from the finance industry, and it raises asset prices. So, stock prices, for example, he saw that the policies back then raised the prices of Mississippi company stock. And so there were these great beneficiaries tightly held. It was a tight knit group of investors in this company, and the price of that stock went crazy upward. And he and a lot of other people made tons of money off of it. But of course, the bubble burst. The money was all still there, percolating through the economy, but it was driving up prices of food, of clothing, of shelter and everything else that regular people buy. They never owned the shares of the company, so they didn't benefit. All as they saw were higher prices, higher cost of living. And so Cantillon developed that analysis at a theoretical level, and we're still using it today. Now, of course, notoriously, the Fed says, they don't touch that theory with a 10-foot pole because it implicates them as the bad guy, as part of a corrupt process that hurts the American people. And so the Austrian school, Mises and Hayek and Rothbard, made a big deal of this analysis. And of course, it makes perfect sense once it's explained to you. But of course, mainstream economics in the elite Ivy League schools, they don't mention it. University of Chicago, it doesn't get mentioned at all. At the Fed, it just doesn't get mentioned. It gets dismissed as not important. But of course, it's really one of the most important things. It causes higher prices, it causes the business cycle, and it causes a government distribution of wealth away from the working class and into the highest levels of the capital owning classes. And again, so this is big banks, big corporations, and the power elite that really control the government.
Yeah, and I think gold has been signaling, transitioning precious metals, gold's been signaling something is wrong with the economy. Over the last 18 months to 2 years, gold has doubled in price. We almost got to that $4,500 range. Right now, it's hovering at 4,000. Silver broke its all-time high of $50 that it hit twice. The precious metals seem to be indicating that the dollar's under a lot of pressure. We're under a lot of pressure. The currency's not doing well. The economy's not doing well. I know you've been studying the precious metals as of late as well. What are your thoughts on gold and silver, what they're doing in this market, and what they may be telling people about what's going on with our currency and with our current economy?
Well, in a free market economy, the price of gold or its purchasing power is the most stable thing in the economy. Okay. So if we had a free market society, if we had a libertarian globe, the purchasing power of gold would stay almost constant over long, long periods of time. So anytime there's a change in the price of gold, it reflects some kind of government intervention and government uncertainty, whether that's inflating the money supply or military tensions around the world or, inflation getting into interest rates. Gold reflects everything that's going on in the world. And so when we see gold, go completely berserk, from like almost down to $1,000 an ounce, up over $4,000 an ounce. That's all driven by government activities in the marketplace. And so that's a direct reflection of what our governments are up to and, creating tensions, spending wildly, inflating madly. This is a direct reflection of all that. And so I'm not the least bit surprised that precious metal prices have gone up. Of course, we're experiencing a pullback right now as the market experienced intense growing pains there as we approached $4,000 on gold and $50 on silver. People were rushing in. The commodities wholesale markets got all glued up. The futures and the spot price got all glued up. So we were experiencing growing pains Metals were being flown around the world, and markets were seizing up, and refineries couldn't handle all the the product coming in. And the premiums on coins were swinging wildly. Okay, that's just growing pains in the market. Everybody rushing in to get involved, and I think that's a normal part of markets. Markets never go in linear fashion up or down. Only in my mind do I think prices should just go to $10,000 immediately. That never works out that way. If you look at any price index for any commodity or any stock or any bond, you're going to see fluctuations, and that's what we're seeing right now. The period before that, when it went from 1100 to 44,400 or whatever it was, that was almost a linear up period. It was very, there was a period where it leveled off and then it took off again. That's unusual. What we're experiencing right now is not unusual, and it's not unexpected when everybody's rushing into a market the way they have been in the last month or so.
Yeah, it's been very interesting. I used to own a coin shop, and now I run a national precious metals dealer as well. And just seeing those prices go as quickly as they have, I've been watching this market for almost 20 years. I've never seen anything like it on the charts. And one of the interesting things that you and I were talking about before we started recording was silver and how silver is different. You've been studying the volatility of silver. Any insights there for our listeners on why silver acts a little bit differently than gold in these types of markets?
Yeah, I mean, silver just now broke through $50, which was the high price in 2011 and 1980.
Mhm.
So in gold, its high price was, 850 and so forth. We had already broken through those high prices on gold, but not on silver for so very long. But there are a lot of factors that explain that. I mean, there could be manipulation of these markets, and there probably is. I mean, everybody wants to manipulate markets, and some people have been penalized for doing that in silver. But I think the fundamental factors play a huge role here as well, and I think that the silver is we get most of our silver as a byproduct of other metals. And the other metals, the industrial metals like lead and zinc, copper, and so on, those metals all experienced a big price rise at the beginning of the housing bubble in the early 2000s. So we had the housing and real estate bubble in the United States and Canada and the UK and other countries. And then we had infrastructure bubbles in places beginning at this same time in places like China and India. And so all of those, housing and infrastructure required a lot more lead and zinc and copper in order to accomplish all that. So the price of those metals increased a lot back then. And silver, we get about 70% of silver mining as a byproduct of those industrial metals. And so we've been getting a lot more silver dating back more than 25 years as a result of this byproduct production. And lead, zinc, and so forth, copper have been relatively high for the last 20 years. And so I think we've been getting sort of bonus amounts of silver since the last price high in silver. And that has been a suppressing factor on silver prices. But notice what happens. And I'm anticipating the economy is going to experience a long overdue correction in the overall economy, the overall stock market. And so those industrial metals might not be in such high demand. And so if those industrial metals fall, the byproduct production of silver in those metals will also fall or be relatively less. And so if that headwind occurs at the same time that there's an increase in the demand for silver, we should expect the price of silver to outpace any movements in the overall market for precious metals, gold, palladium, platinum, and silver. So, there's a lot of, historical knowledge that people in this market have about silver gyrating wildly around the price of gold. And I think it's the fact that most silver nowadays comes as a byproduct of industrial metals that explains that variability and sets us up for what might happen in the coming years.
To kind of wrap this all up and put it in a bow and looking at what we've talked about, do you think it's possible, Mark, that we could eventually go back to a bimetallic standard like we had in our country for so long before the Federal Reserve? And if so, would we have to have some sort of debt collapse or jubilee in order for that to happen? This is a question that a lot of my listeners want to know. Can we ever get back to having honest money? Is that truly possible, do you think?
I do think it. I do think we're going to get back to an honest monetary system. But getting there could be incredibly painful because right now we're taking baby steps on the road to hyperinflation, where the government has to increase the money supply in vast quantities and driving down the purchasing power of the dollar much more so today. I mean, other countries, even advanced countries, have experienced these hyperinflations where money becomes difficult to use because you have to use it almost immediately. You can't hold money balances because it's losing purchasing power so rapidly. And under those conditions, people will start to barter and they will start to use gold and silver to make exchanges. And so I think, if the government doesn't change things around, and I have no anticipation that the current group in charge of things wants to change anything, then I can see us being essentially almost forced back onto a commodity, honest money system using gold and silver. And I think if we go the painful route, it means people are going to resort to barter, and it's going to be people using the old constitutional silver and gold for large purchases because money is just not going to be holding its value if the current trends continue.
Yeah, I agree with you on that. And Dr. Thornton, thanks for joining the program. We'd love to have you back if you'd like to come. And for those that are interested in your work and hearing more from you, where can they reach out to you, maybe to access your podcast and other work that you have?
Yeah, I'd love to come back on the show. Love your work.
Thank you.
And our webpage is one of the largest web pages in the world. Everything's for free. There's no registration. MISES.org. And we're running a special where you can get a free copy of a new book. It's a collection of essays by Friedrich Hayek, who was Mises's student, won the Nobel Prize for his work on the business cycle theory. He actually hinted at the development of cryptocurrencies. So just put Hayek in a comment below in the show, and we'll get you a copy of this very interesting book. We're here. I know a lot of people are down on young people and why they don't know solid economics, but that's what we specialize here at the Mises Institute. So I encourage everybody to check that out.
I appreciate that very much. I appreciate the Mises Institute for that. I have two kids that one's 22, one is 16, about to be 17, and they're having to learn how things work. But they've got a front row seat, Mark, to the problems. And I think this type of research and education would be hugely beneficial to that generation in learning what potential solutions could be. So we thank you for doing that, and definitely we will make sure that everybody that puts in Hayek in the comments will get a copy of that, and it's very generous of the Institute. And again, thank you for coming on. We'll definitely have you on again in the future.
Thank you, Rob. It was great.
We are living in unprecedented times. The precious metals complex is trading still, despite the correction, at very, very high levels. And the U.S. debt just reached $38 trillion. What do we make of this? It is a fascinating time. And as you can tell, I'm back in Frankfurt. I'm back in the studio. And I'm really excited to have my usual setup here. But I'm also really excited to introduce you to my next guest. His name is Mark Thornton. He's a senior fellow at the Mises Institute. And as you can tell, we will talk about the Austrian economics, or the School of Austrian Economics, and how we apply it to today. Like, what can we learn from it? And what should we be paying attention to moving forward? Really interesting discussion that we have lined up. I'm really looking forward to this. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and we much appreciate it. Thank you so much for doing that. Now, Mark, it is great to welcome you on the program. I'm excited to have you on. Thank you so much for joining us.
Oh, thank you, Kai. It's great to be here with you today.
Yeah, really looking forward to this. As I mentioned to you before hitting the record button, I think you're the first guest that we had on, or that we have on from the Mises Institute. And we often use the term Austrian economics here on this program, but I don't think we've ever explained what it means. So I'd love to start off this discussion, Mark, real quick. Can you give us a 30, 60, maybe 90-second overview? What is the Austrian School of Economics?
Sure. The Austrian school goes back into Europe, into Austria, in the 19th century, founded by Karl Menger. And then, many students developed in Europe, including Ludwig von Mises. And he fled Europe during World War II and brought Austrian economics to the United States, along with his student Friedrich von Hayek, who won the Nobel Prize, and Murray Rothbard, a Native American. And the Austrian school really is a theoretical school. The Austrians invented, the concepts of opportunity cost, comparative advantage, all the things you learn in the first few chapters of a college course, and really supply and demand as applied to marginal economics. So we're all about economic theory and less about, charts and numbers, computer programs, data sets, that kind of thing. So we bring a fundamental analysis to the economy and to markets and to economic situations. And so that's really the important point. Is it's a theoretical approach, deductive approach based on logic, reason, and human action.
Really appreciate that, Mark, because I don't think we ever explained what it really means here on this program. Of course, a lot of our viewers know that, but I figured let's fill in the other half that might not be as familiar with that term. But Mark, you mentioned something interesting, like the economic situation. Help us interpret it a little bit from your point of view. Like, where are we at right now? How would you describe it?
Well, in terms of the economy, I'm very, very concerned with the world economy because of the direction that governments have taken us. They're spending out of control. They're all borrowing huge amounts of money, and they're all printing up massive quantities of the fiat currencies. And so, the U.S. dollar is down relative to some of the other currencies, but generally the trend of all fiat currencies right now is down and down precipitously in terms of their purchasing power. And certainly, if you want to measure it versus the price of gold, the price of silver, and so forth, it's obviously that our money is able to purchase less and less. And in the United States, in my home economy, and in many economies around the world, you have a huge percentage of the population where their real income, when it's adjusted by prices, is actually falling so that they can buy less and less over time. And that's a very dangerous situation because at the same time, the governments are making the economies less competitive and less productive. And the trade war on top of that is the thing that's the scariest of all, because I know, it comes and goes and President Trump does this and that, but we're still moving forward with a world trade war, and this has military implications, and we have military hotspots around the world. And so this is all very, very concerning to me as an economist, because, of course, war is the worst thing that the government can do, but inflation is also terrible, and so is these massive government debts. And politicians around the world, whether it's the United States, Canada, Europe, the European economies, Japan, and even China and many other countries, they're running up huge debts. And you know, even if they're not printing up money now, they're going to have to print up more money in the future to pay for all this. And so the fundamental status of the economy is that it's weakening worldwide in things like the military situation, the trade war, the budgets, and the money printing are all massive concern to me.
Yeah, reminds me sort of what the Austrian School of Economics has been warning about all along is exactly what is happening right now. Would you underwrite that as like this is the end game based in your economic theory here? Is that what we've been fearing all along?
Yeah, I mean, it certainly is. And of course, an inevitable consequence of all this is that politicians want to push for more government intervention in the economy. They see all of the micro problems emerging because of the macro problems that they're causing. And so their first instinct is to enact even more government intervention. And I think that's where President Trump's trade war is coming, which, of course, invokes retaliation from other countries. But they're, in the process of, making it more difficult for families to earn their way. They're making it more difficult for companies to be productive and to employ workers. They're absorbing capital throughout the economy so that we're putting more of our real assets into the government instead of into the productive economy where it needs to be to employ people and to buy capital in order to raise people's wages. And so they're doing exactly the wrong things, moving ever closer to socialism rather than to a free market prosperity.
Yeah, it is interesting. We're seeing that currently on the critical minerals side, but also on the AI chip side, where the U.S. has taken a stake in Intel. We're seeing it now on the critical minerals side, where the U.S. has invested in MP Materials and many other companies as well. Trilogy Metals comes to mind in Alaska. So you're saying like this is a step in the wrong direction. The government may be overstepping its powers here or overusing its powers?
There's ways that the United States can increase its production of anything, including rare earth and critical metals and so on and so forth. But the government coming in and buying stakes and providing subsidies and granting massive loans is obviously the wrong thing. And you have President Trump himself and President Trump's supporters and admirers who were very critical of President Obama making those same subsidies and investments in solar energy and other, crackpot ideas. They were all critical back then of President Obama's choice of favorites, but now they're seemingly saying, well, this is the way to salvation when it's the exact same stupid policy. And so, if we peel back, a slight veneer, we realize that that it's the wrong way to go. I mean, that all of President Obama's subsidies and bailouts and massive loan guarantees to his favorite firms, they all failed. And we're going to find out, that the investments in Intel and rare earths and tungsten and all that kind of stuff, it has a short-term blip where you seem to get, that's getting some action. But down the road, you're going to find, a crony capitalist company that's underproductive and living off the taxpayer, really.
But before we come to the micro, and I do want to discuss with you gold and silver, because I know you've produced videos on that topic as well. I want to stay on the macro for just a bit longer. In my intro, I mentioned the crippling U.S. debt situation, over $38 trillion. The last trillion was the fastest added ever. How does that sort of fit in? Like, what is the end game here based on the Austrian framework? Like, what are we looking at? What can we anticipate?
Well, I mean, there's many different aspects. When you've got $38 trillion, there's lots of negative effects. And it means we've put $38 trillion of real resources into the government, which is not productive, it's not efficient, it's not producing goods and services. It's money that politicians have borrowed and they've spent it. And we don't have anything to show for all of that money, but the debt itself. And so now we're seeing the chickens come home to roost on that massive debt, because the financing costs, the amount of money that Americans have to pay, or excuse me, the American government has to pay to finance that $38 trillion is rising. It has risen. It's going to continue to rise, and it's over like $1 trillion a year right now. And I think it's the largest single item in the government budget, or at least one of the top items in the government budget. So that's an expense that's going to, even if everything stayed the same, it's going to, that's a perpetual expense basically. And of course, it's scheduled to rise. And when interest rates go higher because of the inflation factor in interest rates, I think, the Fed's going to cut rates in the short term, but in the longer term, it's going to force interest rates higher. And so that debt servicing cost is probably going to grow. And that's really the thing that I worry about, because, they can't really tax the economy anymore. We're at the limit as far as taxation is concerned. The borrowing costs are crippling the private sector. So the only thing they really have to turn to at this point, and a lot of experts in this area are anticipating them relying increasingly heavily on simply printing the money, rolling over the debt, so the government will borrow the money, and then the Fed will buy the debt from the marketplace, but they'll have to print up money in order to buy that. And, we already experienced that during COVID, where the Fed bought up all the debt that the government was incurring in the short run, and everybody said, well, it seems to be okay. But then, of course, a year, 2, 3 years later, we were experiencing 9% inflation. So that's what we have to look forward to.
Inflation is an interesting topic, Mark, because it is Fed week. So I almost forgot that in the intro, but it is Fed week. Although it almost seems like a nothing burger this week, it doesn't really seem to be making headlines. At least I'm not hearing that much. But the inflation topic is an interesting one, because that's sort of the only data we got last week. We didn't get any unemployment data, but the Fed is putting heavy weighting on the unemployment trend that we're seeing right now, and the employment data in general. Do you think they're making a mistake? Are they focusing on the wrong end here, meaning the unemployment data versus inflation?
I think the Fed is almost always making a mistake. And I should say that when Austrians, I should qualify my statements that we think that inflation is when the Fed is printing up money and injecting it into the economy. Of course, most people speak of inflation in terms of the effect of that policy, which is rising prices. And there is a disconnect between the two in the short run. They have to issue the money, it has to circulate in the economy, and then prices rise. So the government gets to buy things before the prices go up. The government contractors get the money, the banks and the speculators on Wall Street, they all get the money first, and then prices rise, and then you and I get the money, but we have to pay the higher prices. And so that's an important distinction that Austrians do make. And, the Fed no longer believes that they are responsible for the higher prices. They ignore and deny the fact that increased money supply increases prices. So they're in a total disconnect, and that's why they make mistakes in terms of policy and timing. And frankly, right now they've always been telling us going back in time, that they're data dependent. And now that the data is not there, well, they're just proceeding along their traditional playbook. And their playbook only has one play, that's printing money. And they see political problems for themselves. They see problems in banking, specifically. They see problems in the economy, and they see a stock market that's probably weakening, it's kind of leveling off, and so they're jumping and using their number one play, their number one tool, their only tool, which is to print money, which means they're going to cut interest rates and inject money into the banking system.
Mark, like, it's always interesting. Like, I like talking theory, and it's popular, of course, to bash the Fed. But what should they be doing? Or maybe let's roll or approach it from a different. Is the Fed even relevant these days? And how would you substitute it? And see, maybe if we agree that they might be relevant to a certain degree, what should they be doing?
Well, I think it is relevant in the sense that what they do does matter. They're the ones that are responsible for creating higher prices in the economy. They're the ones that are responsible for destabilizing the economy by creating business cycles. Okay, so they reduce interest rates. They engineer investment demand on Wall Street. They drive up asset prices. They create booms. But of course, as that money circulates, and as prices rise, those booming investments sour out eventually down the line. And it can take a long time, depending on how much money they're willing to inject. And they're also responsible for distorting the distribution of income. So when they're in an active phase, they're benefiting stock owners, asset owners, bankers, the government, and politicians. But simultaneously, they're undermining the American family. They're undermining real wage rates in the economy. They're undermining productive investment and capital in the firms that actually produce things, provide services that increase the economy's productivity. Everybody knows that small companies that are making investments that are, creating efficiencies and productivity, that those are really the source of new jobs and higher wages in the economy. And when the Fed is printing up money and sending it to Wall Street and sending it to Washington, D.C., that means there's not money going to those small companies that we haven't even heard of yet. But that's really the source of growth and strength and prosperity in the economy. And the Fed can get away with that because, nobody knows about Corporation XYZ or Bob and Ted's magical company out there that's going to be, the next big company on the horizon that's going to produce the next great product, that's going to, create the next great technology that's going to make us more efficient and that sort of thing. So they can get away with, with the price inflation distortions and the business cycle, and also this maldistribution of income that they cause that makes the rich richer. The people who already have money and can leverage up, they get richer. But the working class in America, who sees their real wages undermined and the companies that they work for unable to grow and expand and become more productive and more efficient, those are all the people that are getting hurt. And those are the people that are suffering right now.
Oh, and they are, based on the unemployment data and the other data that we're seeing. It is not looking great. Credit card delinquencies, car loan delinquencies are all increasing as well. It's not looking pretty out there. Let's be honest. But let's try to put that into context with the rising gold price as well. And I'm wondering, Mark, maybe on a very high level at first, but what is gold and silver to a degree telling you here as we actually dive below 4,000 as we speak here, Mark?
Gold and silver, excuse me, are real money. That's what the market chose as money thousands of years ago. The government has intervened in money slowly. It took them about 100 years to go from gold and silver a 100-year transition to where they could just print up pieces of paper. But they did it. They got away with it. They're getting away with it. But they can't completely hide what they're up to because gold and silver prices are reacting to this runaway spending, inflation, and borrowing. And, and so we've already seen a big increase in gold prices from like 1,000 to over 4,000, and silver prices from around $10 on up to $50. And so this runaway government is showing up in the markets for precious metals. I'm not very surprised at that whatsoever, and I think that's going to continue. I know that we're going through a painful pullback right now, but if you look back in the charts, you'll see that there's been, a many 100% increase in the price of both of those metals since they bottomed out a number of years ago. And, there's nothing really to suggest that that's going to stop or reverse itself in any kind of major way. I mean, right now, this is really being led by other central banks themselves. So the dollar is the world dominant currency, but other central banks no longer trust the dollar. So it's hard to believe that individuals could trust the dollar as a store of value. Of course, we have to use it as a medium of exchange. That's still relevant, but as far as being a store of value, even central banks, other central banks no longer trust the dollar, and an increasing number of individuals and companies are turning away from that. That's really what the whole BRICS currency alternative is about, where you have, Brazil, Russia, India, China, South Africa, and other countries wanting to get away from the dollar, the monopoly dollar, and have some alternative that's more stable and less subject to U.S. control.
I was going to say, the dollar's been declining since the 70s, since Nixon took us off the gold standard, or took the U.S. off the gold standard. Why is it now so pertinent to leave the dollar system? And it seems to be there was a rethink that was going on, and I'm struggling a little bit that it's just the loss of value of the U.S. dollar as a currency. I think there's more at play, and you sort of hinted at it with sort of your last remark here. There's geopolitics at play as well. So I'm trying to understand and put maybe the rise of the gold price in context. How much does it have to do with the loss of value in the currency versus just geopolitical turmoil on the other end?
Well, there's so many factors. I mean, that's the thing about gold and silver as money, is that everything affects them. And I showed recently, if we did have a free market world economy, that those two things would be almost perfectly stable. But in the world where you have a highly interventionist economy and competing countries where the U.S. is no longer, the sole dominating factor in the world, you have China, which has risen to an economic superpower, and it wants to have a say-so with respect to money. And so it's organized the BRIC countries. And so it's actively trying to take its role as a world dominating currency. And then, of course, you have the situation in Russia, where President Biden essentially took away Russia's foreign exchange money and its ownership of U.S. government debt. The Europeans did the same thing. So the Russian, not only are the Russians no longer trusting the United States and the euro with respect to this paper system, but all central banks are now worried that if the U.S. can do this to one country, if the European Union, the European Central Bank can do this to one country, and you've got runaway government where politicians think that they can do anything they want, then why not, the U.S. and the Europeans do the same thing to other countries who don't please them or don't obey them? And so, yes, those geopolitical factors do matter in currency and debt, as well as in this trade war. And so, the trade war is obviously directly linked to this international conflict, because Russia's right in the middle of it, and Russia's friends, India has gotten dragged into this, China's gotten dragged into this, and who's to say the next country that doesn't get dragged into this conflict because of some other connections, economic, political, or military, that they have with some unfavored government actor in the economy. Now, that doesn't mean I agree with everything the Russians or the Indians or the Chinese do. It's just that this is conflict between politicians that could drastically negatively affect your economy, my economy, and our listeners' economy out there in a major way.
Yeah. Well, Germany's economy is already down the drain, so that ship has sailed for us. But maybe just coming back to the currency, I have one last follow-up question before I want to end with some more questions on gold here. But China is pushing more countries and more trading partners to transact into yuan. Is the Chinese economy or is the Chinese financial system strong enough to demand that already? Are we at a turning point here where China is starting to make inroads? BHP was an example where 30% of their iron ore trade has to be settled in yuan. As a signal, perhaps, is the Chinese financial system strong enough to handle that already, or is there just a blip?
Well, it's not a blimp. And, as I mentioned before, it took 100 years for the U.S. to become an economic superpower. It also took 100 years for us to turn the gold standard system into a pure paper system. So these things take time. I mean, for sure. But China's been working on this for quite a while, and a lot of its strategic economic measures in terms of refining gold and refining silver, refining rare earths. This is all part of it. President Trump didn't realize when he started this trade war is that he was not holding all of the economic cards, that China was actually holding many more cards than anybody thought. And so they've been working on this for quite some time. And, the BRICS currency union that they're developing is developing very rapidly. And the moves that the United States has been making are really, as I see it, they tend to be falling directly into the hands of the Chinese. And so what we've been doing, what President Trump has been doing is, unfortunately, it has the effect of actually strengthening China's hands, and they're developing, a trading system, a currency trading system, a gold trading system around the world, and the fact that Western markets for gold and silver really clammed up recently. I mean, that's part of the whole downdraft in the metals market is that we couldn't handle the expansion in this marketplace that you and I have been looking at for a couple of years, and these London and Chicago and all these marketplaces didn't really measure up to that expansion in business. But China is working on expanding all of those businesses. So the trend is in China's favor as I see it. And it's going to take some time. I don't see, the dollar disappearing and the Chinese yuan magically dominating the globe in the next couple of years, but that's the direction.
No, I appreciate that. I really appreciate your remarks on that topic, Marcus. I think it is an important trend that is accelerating. Maybe last 90 seconds here, Mark, on gold and silver. As we were speaking, gold is below 4,000 and silver is way below $50. Again, I read $46.50 as we speak. What should investors do right now?
Well, I'm not a financial analyst, but I see this as a very long-term trend that has positive implications for gold and silver. If the government's magically, or if they tried to fake us into thinking that they weren't going to spend more, borrow more, and print more, we don't see any signs on the horizon that that's going to take place. They haven't made a dent in the U.S. in terms of government spending. President Trump is, attacking the Federal Reserve for not reducing interest rates and printing more. He's appointing people who advocate for more printing. He's been beating up Jerome Powell, who had been, towing a tough line on monetary policy, and now Powell has caved in concessions to cut interest rates going forward, which means more printing. So I would view, there's been a tremendous rise in both metals, and the painful adjustment downdraft that we are experiencing currently is, it's relatively small compared to the big up move. And I think some of this is obviously profit taking and short-term investors running for cover, but it's also the fact that this market is expanding, and instead of just silver stackers and central bankers who are long-term holders, we've got a lot more traders and speculators and day traders and machine buying and all that have entered the marketplace. And we've seen a lot of disruption in the formal markets in London and in the United States. We're seeing refineries all backed up. We're seeing the spot price rise above the future price. So this is an abnormal situation right now.
No, fantastic.
Although a cutback in prices is fairly normal.
Yeah, I think we're overextended over the 200 moving day average by over 30%, I believe. So it is normal to see that setback. So personally, I'm not too worried. Of course, it is sad to see $4,000 losing the four handle on the gold price here. But hey, as you said, the trend is intact. So I'm not too worried. I think we can all see where this is headed long term. And really appreciate your insights, Mark. Really appreciate you joining us here on SOAR Financially. Where can we send our audience to follow more of your work, Mark?
Well, Mises Institute, mises.org. It's one of the largest economic web pages in the world, one of the most trafficked web pages, and you can read everything that we do. We have like 5 different podcasts, and right now we're offering a free copy of Friedrich Hayek's, the greatest hits of his articles, which contains, his article where he suggested the idea of Bitcoin. He was the major inflation fighter during the 1970s. He wrote about how the worst get to the top. So if you want a copy of this free book from the Institute, just put a comment on this podcast episode that I want Friedrich Hayek's greatest hits, and I'll send you the link to it.
Perfect. Awesome. Yeah, just put hashtag Hayek or something down below so it's easier to track. And really appreciate that offer, Mark. Much appreciate that. It was a great pleasure having you on the program. Next time we'll need to schedule like 3 hours. Just to get through it all. Really, there's so many things that just you mentioning, just bringing up Bitcoin, like how does that work in the world where gold and everybody is buying gold and silver right now to protect, and just the theory behind it would be really interesting to discuss. We haven't even talked CBDCs, so we'll need to do a part 2 here, Mark, very soon. So really appreciate your time. Thanks so much for coming on.
I'm Charlotte McLeod with investingnews.com, and here today with me is Dr. Mark Thornton, Senior Fellow at the Mises Institute. Thank you so much for being here. Great to have you.
Oh, it's wonderful to be here with you, Charlotte. Thank you.
Really good to have you. I'm excited for this conversation. And I think that many of our audience members will probably be familiar with you already. But I was thinking, since it's our first conversation, maybe you could begin with a brief overview to your background and the work that you're doing right now.
Well, I'm a PhD academic economist. I work for the Mises Institute and have been with them virtually from the very beginning, and promoting Austrian economics through our webpage and through academic publications and popular publications. And we have one of the world's largest economic web pages. We have 5 different podcasts that I try to be as much a part of as I can be. I work with the Academic Journal. I teach at Auburn University. My research has been on markets in general, but also on the war on drugs and the work of Ludwig von Mises and a bunch of other things, including the American Civil War. So I do a lot of different things.
Clearly, you have a lot going on, and we're going to go down some of those paths today. I was hoping our audience has a strong interest in gold as well as silver. And I wanted to start there because I think it will open up different paths that we can follow. Beginning with gold, we know that the metal has been on a record setting rise this year. Of course, we're currently in a bit of a pullback. But I'm wondering if you can tell me what you see as the key drivers there. What would you pull out for gold?
Well, I think it's important to realize that gold was money until the government took it over, gold and silver. And the reason the market established gold and silver as money thousands of years ago was because of the physical properties of those metals made them ideal for money. And the big conclusion is that they held a very stable value versus all other prices. So when we see abnormal prices for gold in terms of fiat dollars, it's all really the result of government intervening in the market, replacing gold, printing up money, endangering economic performance, extracting resources, trade wars, military actions, all of these things. I know that a lot of commentators on gold and silver, they like to fixate on corrupted markets or the Chinese or war, but really gold absorbs all of the uncertainties of the world. And when the price lets up a little bit or contracts a little bit, it's the world breathing a sigh of relief. But the general upward movement of gold prices is clearly a result of government overspending and not really caring that they're overspending, borrowing beyond belief and not really doing anything to slow it down, and then just printing up money to pay for the borrowing. So it's really runaway government spending, borrowing, inflating that's pushing these metal prices to record levels really across the board.
I'm hearing a lot of focus lately on that idea of gold's price move as a warning signal. So, anything further you would add there? Because I think that's quite an interesting topic to explore for investors.
Well, I think the biggest worry is international conflict. The conflict with the Chinese, with the Russians, now with India, with the Europeans, even with our U.S. neighbors in Canada and Mexico, with the trade war. But it goes beyond that. It goes to President Biden attacking the Russians, taking their treasuries, the Europeans doing the same thing. And the trade war, the trade restricting policies is really an extension of government intervention in our economy, but it's also pushing us ever closer to military conflicts. And so I think that, and military conflict would be devastating to our economies and to the economic lives of everybody on the planet. And gold is signaling its concern about the trend of where we're going with all that. I think in everyday American life, we ignore those kind of things in order to pursue our daily activities. But gold doesn't ignore those kind of things. It has to put up with that every day. It's absorbing all of that information, and we're getting a daily report card on what our politicians are doing to us and the threats that they're imposing on us as a result of their foreign policy and their imperial designs. And of course, China has very similar designs. They see themselves as a world economic power, deserving of a status. And countries around the world each have their own objectives. And if we forget that and then we try to have our way as far as the United States is concerned, I'm an American, And I'm very concerned about our own foreign policy and what it might do to the global economy.
Well, I wonder if you can say a little bit more about that because people are very focused on the US and what happens internally there and how it can impact global markets. So, what would you add there?
Well, I think to add one of the problems I foresee is I don't see the U.S. economy as healthy as, for example, the unemployment rate reports or GDP reports or the stock market reports. One of the things that Austrian economics teaches us is that the numbers can be rigged in a certain way through the inflation process. So if they print up money, they can increase certain types of investment, advanced technology investment things that will push GDP numbers and employment numbers, electrical usage numbers ever higher, and it makes the economy seem strong. But in reality, what we know is that the majority of Americans are suffering from declining real wage rates. Their budgets are going downhill because of inflation. They're able to buy less and less. I can tell you in my hometown, the restaurants that were filled to the brim a couple of years ago are now, no reservation required. You can see that slack in the real economy right on Main Street. So I don't think the economy is very healthy. And I think that, politicians become even more aggressive. And they very often use military actions as a way of covering up for the fact that they've screwed up the economy. And I think one of the things in particular that I'm looking at is these aerial attacks on these little fishing boats off of Venezuela. And that seems like it's a prime case where politicians are setting themselves up to engage in a faux military conflict in order to support their reelection campaign on the horizon. But Venezuela is allies with China. They're allies with Russia and Cuba. If we attack them, that's going to escalate in those circles as well. So this is a very dicey situation, I think. And it's one that the American people don't really even know about or care about. They don't know anything about Venezuela. And they don't care to know about Venezuela, and they like Venezuelans just fine. We have lots of Venezuela immigrants into this country, and I love them. Love their food, etc. But we don't want to get the United States in a global conflict because that would bring down the world economy.
So potentially these events unfolding internationally, distracting from what's happening in the US itself. I know from reading some of your writing that you see the US moving into a hyperinflationary scenario. So I'm wondering if you can outline, I know this is a big question, but outline how we get there from where we are right now. I know we just got those latest CPI numbers showing 3%. And of course, you've already talked about how those numbers can be fudged. So what would you lay out here?
Well, the circumstances do have to be very particular to get into a hyperinflation. It happens on a fairly regular basis, and it even happens to world-leading economies. I mean, France and Germany have suffered from hyperinflations. We had a hyperinflation in colonial America, so it's not out of the question. It can happen, and mostly around wars, though, and that's why I bring that up. I told you I don't predict gold prices and things like that, but one of the first presentations I ever gave, they asked me to comment on these other predictions, and I said, well, ultimately, the price of gold in terms of fiat dollars is going to go to infinity whenever we get into a hyperinflation. And what that takes to engineer a hyperinflation is, of course, large-scale government spending, large-scale government borrowing, a huge national debt which cannot be paid, and then, of course, the politicians continue to print in order to finance the deficit. And, of course, the United States is running $1 trillion a multi-trillion-dollar deficit, and the interest payments are already $1 trillion a year. It's one of the biggest budget items, and it's scaled to go much higher in the future, especially if interest rates goes up, which is related to what people think about the dollar and its rate of depreciation. And we have just going through a year in which the dollar is depreciated considerably in terms of double digits against the other fiat currencies. So we've got to be concerned about that. If the United States was to go into war and having to spend a lot of money on military armaments to devote a lot of the labor force into the military, the economy would shrink, the government would grow, and the need to finance that with printing would be enormous. And of course, if that resulted in a loss in the people's perception about the future of the dollar, then they would start dumping dollars into the American economy, and that would further exacerbate the decline in the value of the dollar, the rise in global commodity prices, oil, metals, grains, etc., and the inflation would proliferate into American life. And we would look back on 3% as the good old days relative to what we might get under that type of scenario. And then once we get into that scenario, then you have to depend on politicians seeing the light and realizing what they've done and asking for forgiveness and reforming the economy. But that is very difficult. That almost never happens except in during periods and acts of great desperation on the part of politicians. So it's a lot of trouble and enormous uncertainty that could be revealed to us in the months and years going forward.
Definitely, I could see the way you lay it out there. So this could happen, not guaranteed to happen. You mentioned this needs a quite particular set of circumstances. And I know earlier this year there was, I don't know if optimism is the right word, but there were some conversations around Doge and Elon Musk coming in. Maybe they're going to clean things up. That seems to have fizzled at this point. But do you see a scenario where we get something a little bit more optimistic?
Well, yes. And, the Doge thing, there was never any promises. There was never any consensus. Elon Musk and his team never had really much in the way of authority. And as a matter of fact, their authority was questioned right and left and still is being questioned in the courts today. So there wasn't much punch behind that. But we have had periods where we've gotten into inflation in the 70s and other periods, and the U.S. Has made more formal declarations. They've passed legislation. They brought in Paul Volcker in the late 1970s, and they made what appeared to be a good faith effort to at least cut back or reform the system, and the value of the dollar strengthened as a result. So if the politicians commit to sounder money and make a legislative commitment, if they commit to balancing the budget or, reducing the deficit in some formal way, that would really throw the brakes on the precious metal markets and strengthen the value of the dollar, probably reduce interest rates and spur real economic growth. Because if the money's not going to the government, it can go to the economy, it can go into small business. They can buy capital and computers and productivity enhancing devices so that Americans can be more productive and more competitive on the international economy and on the international scale. And so you can get periods of improvement, and we have experienced probably 3 or 4 bouts of that reform-mindedness. I mean, not reform-mindedness enough to bring us back to the gold standard, but at least good talking points and in some cases legislation or personnel changes at the Fed things of that nature. So yes.
I think it's good to look at the flip side, especially because when people look at what's happening today, I think a lot of the time they wonder, all right, is this similar to another time in the past? Any other time periods that you would say remind you of what we're seeing right now?
Wow. Well, no, I think I'm thinking of the current situation as more of an unprecedented place, but I think we could be, the stagflation of the 1970s. It has a lot of parallels. At the Fed, for example, in the 1970s, they didn't believe that the money supply was responsible for higher prices in the economy. And the current Fed doesn't believe that their own policies of printing money are responsible for increased prices. And there were some very dovish people appointed to the Fed in the 1970s who allowed politicians to strong arm them into dovish low interest rate policies. And today, we have President Trump and President Obama and President Biden. They were all appointing more dovish people to the Fed, to the point where Jerome Powell, who was a dove, it was considered a war hawk on inflation. So yes, I mean, in that sense, there's a direct parallel, and we have really been feeling the effects of this for years now, where the adverse effects of inflation are really harming middle class America. The Fed and the money printing, it causes higher prices, it causes the business cycle, it causes the booms and busts, but it also causes a artificial redistribution of income and wealth from the middle class to the upper high income, high wealth individuals who can really benefit from those artificially low interest rates, because artificially low interest rates push asset prices much higher. So stocks and bonds go up with aggressive Fed policy. And so the wealthiest in society benefit, but the working class, whose companies can't afford new tools and computers and productivity enhancing devices, their wages stagnate, and then they lose purchasing power from price inflation. So we're definitely experiencing that. 50-60% of American families right now are seeing declining purchasing power of their income. So I'm talking about people who are working full-time, maybe working 2-3 part-time jobs. So we're talking about working people, and they're falling behind. They can't pay their bills. They're running up credit cards, and and they're being hurt, they're being harmed, and they don't know why. And they're having to explain to their family why they can no longer afford, this type of cable bill or this kind of internet system, or they can't get new phones, or we're going to have to do with less, or we're not getting a new car this year. All of those decisions, which were built into the family budget, now cannot be made because of what the Fed has been doing to us, especially since COVID, when they went ballistic with the money supply, where the government spent trillions and trillions of dollars, where they sent everybody home. So we had an unproductive economy, just fueled by the money drug, essentially.
Well, and the Fed is very timely to talk about right now because we have the meeting coming up later this week. I'm wondering what you see as the Fed's path forward. So we got an interest rate cut at the previous meeting. I know widely expected at this one is another cut, but what are you expecting to see? What commentary, and maybe if we look further into the future beyond 2025, what are you expecting?
Well, the Fed is a game of confidence. They have one tool, they have one policy, they can print money. And so they want everybody to believe that they are not responsible for higher prices, that they will come to the rescue if the economy needs saving, but they're ultimately doing the job of undermining the productivity of the economy every day. And I do expect them to cut interest rates. But of course, what have we been told? We've been told the Fed is data dependent. The Fed is data dependent for years and years and years. And now that the data is not there, they're saying, well, we can do without the data for a little while. And so they plan on cutting interest rates. I suspect that policy is going to continue, and then the stock market is going to get in trouble, and they're going to go bananas on the interest rate lowering. They're going to stop tightening, their balance sheet, and they're probably going to loosen the balance sheet and start buying more assets, mortgage-backed securities, and probably long-term government bonds is the place that they're going to concentrate their effort in over the next couple of years. And then, of course, President Trump is going to replace Jay Powell as chairman. Now, Jay Powell could stay on longer past the spring of 2026. That's probably not going to happen given the amount of money that he'll be able to charge for speaking fees. But President Trump's going to replace him with another dove who's going to be even more aggressive with monetary policy. And then there's another appointment coming up after that. So, President Obama, President Biden, and now President Trump are loading up the Federal Reserve with monetary doves who will cut interest rates and expand the money supply at the drop of a hat. And so that's also of great concern to me. And I think people involved in as consumers, as purchasers, silver stackers, I think that's what's driving their behavior. I think it's driving the optimism in the suppliers of precious metals, the investors in precious metals. I'm sure everybody's concerned about the current dip in prices. We went through some severe growing pains in the last few weeks, where we went from a stable market of silver stackers and central bankers who just bought and held. And then all of a sudden, the price started moving so fast that speculators and market timers and traders and speculators were all coming into the market. And we hit $50 and the whole market blew up. Everything was in disarray because of the market experiencing growing pains. And then as we busted through new record highs in all the metals, everything sort of fell apart and people started taking profits and now we're here. But the pullback, even though it's been severe, is a small percentage of the move up from just August of this year. So let's not forget that. And so, the buyers in this market, the participants in this market, the suppliers of these metals, I think generally have a very long run bullish attitude towards their markets moving forward. And I think they see it as a long-term proposition, and that I think most would be shrugging off the current situation. And there's been intense desire to get their hands on this metal on the part of central bankers and stackers and investors. I noticed right before airtime, I looked at, because I've actually made a couple of small purchases myself, and the American Eagles, the premium on American Eagle coins were over 20%. So that tells me that not only are consumers wanting the metals badly, but suppliers want to get their hands on more of this metal as well.
I think I see some of the same themes among our viewers, where many people are looking at this pullback in the prices as a buying opportunity. So they feel pretty good about what's happening right now. And then there is some concern among the people about, is this it? Is this the end of the run? But I think you're right. For the most part, it seems like people do think that it's going to continue. I wonder if we can talk a little bit more about silver. You shared some of your thoughts on the outlook for gold. I know when it comes to silver, you've done some work looking at the gold silver ratio. So I'm wondering if you can share your thoughts there and what that tells us about where the silver price could go in the future.
I'm very optimistic about silver prices because it has, it's such a vital metal for productivity going forward in technology. I mean, all of the really especially important applications in electronics and technology and energy efficiency. It's just an amazing metal, even medical applications. But with more respect to the market, of course, there's good reason why silver moves more erratically than gold. And it relates to the mining industry. Most silver mined is a byproduct of lead, zinc, gold, copper, and a bunch of other metals. In other words, there's been almost no investment for decades now in silver mines, where the primary goal is to get silver. But there has been a lot of investment, especially leading up to the housing bubble in the early 2000s. And so this market analysis dates back to that period, say 2003, 4, 5, 6, 7. You see explosions in lead prices, zinc prices, copper prices. All of those industrial metals broke out from long-term low levels that date back for years and years and years. And all of those metals moved up. And it's not just because of the United States, but it's also because of India and China and all of the emerging markets where people were building infrastructure. So if you're building buildings, you're using, tall buildings, you're using like 5,000 pounds of copper per floor. If you're using conveyor belts and land moving equipment, and everything requires a bunch of lead and zinc, galvanized metal, and so all of those markets broke out back at that time. In other words, the people were investing in lead mines, zinc mines, copper mines, and they were able to extract this extra silver. So you had the extra supply, but you hadn't gotten the demand yet from things like solar power and electric vehicles and artificial intelligence and that kind of thing. So we had the extra supply without the extra demand. And so silver prices remained low or suppressed really by this industrial metal byproduct production. And so if the economy, and this goes back to my very first comment, if the stock market crashes and the economy goes down, we go in, or even into a war situation, or not, just a recession, and lead productions, zinc production, copper production all go down, that means that there's going to be less silver coming out of those mines. At some point, those industrial metal mining operations will either be curtailed or shut down entirely. So sources of silver, and there's not a lot of good new sources of silver coming online. I know there's a lot of new investment just recently, but so that makes me think that, if there's increased industrial demand, increased investor demand, and yet decreased industrial supply, that the price of silver has very good fundamental reasons to skyrocket right past gold prices in a relative sense. And that, therefore, I would argue that the gold-silver ratio is going to decline from over 100 to now it's around 80-something. And I expect that gold-silver ratio is going to continue to decline. And as I pointed out elsewhere, if you get into a hyperinflation the gold-silver ratio could fall below 20 or below 15 even, which was the historical norm of the gold-silver currency ratio. So yeah, I foresee those types of changes going forward.
Well, it makes sense how you lay it out there, and it ties into another point that I wanted to bring up. So, in the scenario that you see coming, gold and silver, we can see that clearly they are places of safety. Are there any other places where investors might be able to go for safety in these times?
Well, that we have to rule out the U.S. dollar at this point, and government bonds, especially long-term bonds. I mean, I think the short-term treasuries earning 3.65% is, decent, but it means you're just treading water, and they're going to be reducing interest rates, and so that's going to be a less good place of securing your funds. I think that in addition to the precious metals, I think the price of oil right now is very low, and oil capital investment into oil and natural gas has been on the wane now for many years. In other words, the capacity to produce oil has not been added to very much. Certainly since President Trump's first term, but even before that, there was a lack of interest because of the environmental hysteria and the suppression of natural fuels in favor of, sun and wind and that kind of thing. So I think that the balance is tipping very much in favor of commodity investments rather than stock investments. And as a matter of fact, I just reviewed a book about commodity investing over the next 10 years. And silver was one of the better choices that the book had to offer. But I think, you have to be a little bit of your own expertise. You need information about particular commodities, but looking at their relative prices, I think energy has been suppressed. So that's oil, gas, coal, uranium, nuclear. All of those sources have been suppressed by the government, and now we have all this artificial intelligence and the immense infrastructure that they're building and the tremendous demands on the electrical grid that they're going to be bringing forth. So we probably would be expecting higher electric prices. So you sure as heck want to be invested against that possibility. So I think my next best choice would be the broad natural energy sources. Because their prices are low, the demand is going to go up, but the capital investment in those industries, whether it's uranium or oil or natural gas or coal, have all been, I think, suppressed by government policy.
It makes a lot of sense. I think it's very fair to say that we're going to need a whole lot more energy going forward. And I think overall you've left us with a lot to think about. But before I let you go, any final thoughts that you would leave people with at this time?
Well, yeah, I mean, I think protection is very important, but knowledge is really, that's why they're coming to your show, is to get knowledge. And I think Austrian economics and our webpage, Mises.org, is a wealth of knowledge. We have a lot of podcasts, articles, videos, lectures, and so on. And right now we're giving away free copies to F.A. Hayek, the Nobel Prize-winning Austrian economist and student of Ludwig von Mises. We put together a greatest hits of his articles. It includes articles about inflation, articles about the prospects of a Bitcoin-like alternative to fiat money, and also one of his classic articles of why the worst always get on top, referring to politicians, of course. So if you put in the comments, I want Hayek's greatest hits, we'll send you the link and you can get a free copy of this book, or multiple copies, actually. It's a great place to start learning some Austrian economics. And Hayek was really the standard bearer of the Austrian school during the stagflation of the 1970s. He's the one that gave the ideological backbone to Ronald Reagan and to Margaret Thatcher. So they both attribute F.A. Hayek's work on inflation as the reason for their economic success. So there's no better place to start than this great little free book.
Well, thank you so much for sharing that and for that offer. We'll have your links in the video description so everybody can check them out. And thank you once again for coming on. This was great. I learned a lot.
Thank you. It's my pleasure.
Of course, and hope to have you back again soon. For now, I'm Charlotte McLeod with investingnews.com, and this is Dr. Mark Thornton.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Dr. Mark Thornton. He's a senior fellow at the Mises Institute in Auburn, Alabama. The Mises Institute is a proponent of the Austrian School of Economics. And I have to say, the Austrian School of Economics changed the way I think. And I've been following it probably since late 1999, early 2000. So welcome to the show, Dr. Thornton.
Mario, it's a pleasure to be with you here today in person. I wake up around 4 o'clock in the morning, and when I don't have too much to do, I love to tune into your show.
Oh, that's great. A lot of people say that, and I'm flattered. Thank you very much. I started this channel 10 years ago, and I'm the home of alternative economics and contrarian views. And unfortunately, the Austrian School of Economics view is still alternative, but I think hopefully more and more people are waking up to it. So maybe you could tell us a little bit about what the Austrian School of Economics is all about before we go into what the monetary system is telling us.
Well, Ludwig von Mises brought the Austrian School of Economics to the United States during World War II. He was chased out of Europe by Hitler, and he learned from some of the great Austrian economists that began the school in Vienna more than a century ago, Karl Menger and Eugen von Bavarick. And it's a free market school of economics. It's a very traditional school that has its roots in classical economics, but made a lot of improvements in the classical school and really has brought the fundamentals of supply and demand and opportunity cost and price formation, all the fundamental analysis of markets were created by the Austrian school. And you'll see their influence maybe in the first few chapters of an economics textbook. Of course, most modern textbooks go off at that point into Keynesian economics and monetarism and a lot of other misleading schools of economic thought. But the Austrian school is grounded in property rights, voluntary exchange, and it's just built up a whole system of economics, including macroeconomics and the business cycle theory, which really helps explain the modern world, as well as the basic free market economy that would exist in the absence of government intervention. And then the Austrians then explain the impact that government intervention will have in our daily lives.
Yeah, the other thing that the Austrian school, I guess, proposes is sound money. And I think that's a really important part of it as well, because...
Oh, yes, absolutely. Sound money, gold and silver, it means that whoever holds the money holds property, it holds a commodity, holds something of tangible value that then they use to exchange for goods and services, labor, and so forth. And so, it's quite natural that if you're grounded in property rights, that you would have to be grounded in sound money rather than just pieces of paper that can be printed up at will by the government and don't represent anything of tangible value, don't represent anything in terms of real property. And so it's a fundamental distinction because almost all schools of economics, other than the Austrian school, don't really see it that way. They see it paper money as a way for the government to save resources and for the economy to save resources. Then that goes all the way back to Milton Friedman's famous article, I think in 1960, where he chided the idea of a gold standard as a waste of resources in the economy.
Yeah, it's interesting because Milton Friedman is seen as a free market economist, like a hero. But I also heard that when Nixon closed the gold window in 1971, he supposedly said that gold would go to zero almost because nobody would want it. And here we are, over 50 years later, and we're at $4,000. But one of the books that I really like from the Austrian school is What Government Has Done to Our Money by Murray Rothbard. And I've recommended it many times for the viewers because it's not a big book and you don't have to be an economist to read it. So I just wanted to put that out there before we proceed. And Dr. Thornton, I mean, looking at the world right now and where the U.S. is, and I cover the U.S. a lot, of course, because it affects the whole world, and 45% of my viewers are in the U.S. I don't think we could be further away, unfortunately, from the tenets of the Austrian school. What do you think it will take for people to wake up to see that? I think the U.S. is going the wrong way. We just saw this big, beautiful bill this year, and deficit spending has continued to grow. Today, as we speak, it's October 31st, and I heard that the U.S. wants to bomb military facilities in Venezuela, which is all part of this fiat system that allows it makes it really easy for countries to wage war. What do you think it will take?
Well, Mario, I agree that the U.S. is moving in the wrong direction on many, many fronts in terms of money and the Federal Reserve and the macroeconomy, the trade war, the government budget, the big, beautiful bill. I mean, these are all moves in the wrong direction. And that's what really worries me, along with the stock market and all the male investments that have taken place over the last 15, 20 years. It makes me worried about the fragility of the American economy, and especially the working class who are experiencing lower real wage rates in the United States. But on that bigger front, with Venezuela and the Middle East and Russia and China, the amount of conflict that's going on right now, and of course the trade war by President Trump is creating tensions between the United States people and countries around the world. And so the direction certainly isn't good. But on an optimistic note, I would think from my perspective, which admittedly here at the Mises Institute may be very biased, but I see many, many more people realizing the error of our ways here in the United States and maybe in other countries around the world. And those numbers are very large, so I think, and the young people that I see that are so eager to learn about Austrian economics, they've maybe experienced economics classes and they realize there's something wrong. And so more and more people, for a variety of reasons, from COVID and the lockdowns, especially the vaccination mandates, the fact that we shut down the economies and forced vaccinations and printed up trillions of dollars to finance that whole crazy zany period, and then of course the inflation that people have experienced, and the rising price of gold. I mean, the media does not report on that. They only report on the gold price when it goes down a lot. So just recently, we've had lots of mainstream people reporting on that sharp sell-off in gold and silver. But other than that, they completely ignore it. And it's beyond belief. I remember back in the 1980s, the business news would regularly report on things like gold. So the reporting is bad, but I think the millions and millions of people who are catching on to the idea that government might be just a criminal syndicate that lives off of corruption and other people's money and counterfeiting at the printing press. I think that those ideas are starting to get out there and they're starting to sink in, largely because of alternative means such as your channel here, that it's getting out and it's sinking in. And the great thing is that people are really, they're turning off cable and the mainstream media, and they're going to alternative sources, and they're getting a whole new set of information and a whole new set of data. And this is occurring daily in terms of millions and millions of people. So I'm actually much more optimistic. At our recent supporter summit conference in Florida, I gave a talk that where I tried to show that everything good in society comes from the bottom up. Our services, our goods, our new inventions, our new companies, everything, including the tax base, starts from the bottom up. And everything that comes from the top down, from presidents and the Congress and the Fed and things like that, all of that stuff is bad. And, I thought it was a pretty simple idea that was really just common sense, but it even struck home with my audience at the supporter summit, which are hardcore Austrian Misesian followers and believers. And these are people who study these ideas. But when I put it in those simplistic terms, people really realized that everything good in society has to bubble up from the ground up rather than from the top down. And I think it's happening on a massive scale.
I agree. And here in the UK as well, we're seeing a lot of people waking up. We have a new political party called Reform that is really, ruffling feathers. So it's encouraging. It's not all bad. And I think a lot of people, like you said, the alternative media, YouTube, people are getting a lot more information. I wanted to ask you because one of my favorite topics, not that I wanted, but because I remember, reading and listening to Ben Bernanke's helicopter speech back in November 2002, and by then I just started buying gold. When I listened to that speech and read about it, I was very convinced that I needed to hold on to gold and keep buying gold, because he basically said that the United States has a technology that is very doesn't cost anything, and they can just fight deflation, just print money and keep price levels high, which doesn't make sense, of course. But central bankers in the fiat currency world, they want the inflation. But yeah, this part here in and I'll show the viewers the book.
It's treatise.
Treatise, sorry, yeah, treatise, uh, or yeah, on page 428, he talks about the cracker boom, and I've put that there. Are we there yet? And I've been covering this for a few years, and I think we're closer and closer. And he talks about here how the crack of boom is when people finally wake up to the fact that inflation is a government policy. It's not because prices go up, which is another thing that they fool us with. They're saying that inflation is rising prices, which is not, of course. It's the consequence. So I wonder if we could start here and you could give us your view of where we are and whether you think we have a danger of a crack up boom where we see the current currency, the fiat dollar, actually crash and become like the continental dollar back in 1781.
Yes, as a matter of fact, I've spoken about this recently on the prospects for a hyperinflation in this current world on a recent episode of my Minor Issues podcast. And, I think it is relatively close. These things, like the business cycle and hyperinflation, they take a lot longer than anybody could imagine, in the lead up to these things. And then they happen quicker than anybody would ever believe them happening. So it's almost impossible to really date these things. But I would say that all the preconditions are currently in existence for continued inflation of prices, continued inflation of the money supply, and certainly the potential for hyperinflation. There's a lot of countries that have experienced hyperinflations since the ones that Mises wrote about in Human Action. So these things are periodic, but if you're talking about the US dollar, you're talking about the top dog in the world fiat money food chain, basically the most in-demand currency in the world. And so it hasn't experienced a hyperinflation. The United States has not really experienced a hyperinflation for quite some time. But the prospects are there in terms of the preconditions, which is runaway government spending, which we certainly have, a runaway budget deficit, which we certainly have in the United States and elsewhere. And then you have a runaway national debt by the government, which we certainly have, and interest payments on that national debt growing in a kind of exponential fashion. And so if those interest payments continue to grow along those lines, specifically larger deficits, larger debt, and increasing interest payments where citizens don't get any services, they only get higher prices. If interest rates are going to rise and the inflation factor in interest rates is expected to rise, especially with President Trump's appointments, his attacks on Jerome Powell, his attacks on the Federal Reserve, inducing a easy money policy or a more inflationary money policy, then yes, I mean, all of those preconditions are currently in existence. And, what we have right now is that even other central banks around the world do not trust the US dollar. And so the US dollar has fallen a great deal so far this year. And that's just relative to other paper currencies. So, that's a very negative sign. That's a black mark on this situation. And so we can see that the preconditions are set for this problem, which will or could ultimately end in hyperinflation, which, some people call it 50% increases in prices per month. That's the way statisticians look at hyperinflations. But of course, the inflation rates in, the German hyperinflation, the French hyperinflation, those increases in prices of goods and services were really astronomical, especially if you calculate them on an annual basis. The rates are so high that it very quickly becomes almost useless to even use currency, just because the currency is just so dramatically losing value. And at that point, of course, I expect people to start using silver in certain day-to-day exchanges. So people will start migrating over to using silver and barter and that kind of thing. We're still a ways away from that, but like I said in the beginning, once these things start to happen, the government loses complete control of the situation. And what we see right now in the United States is a government that's out of control with its spending. It can't even manage to do legislation on a regular basis. The U.S. government is currently shut down, and both political parties have found that it reflects positively on them. Now imagine this, it reflects relatively positively on both political parties that they've essentially shut the government down, out of business. So, that's how bad things are currently. And that's why we have all-time record high prices in gold and silver around the world, is that, citizens, not just in the U.S., but around the world, do not believe in their fiat currencies. Central banks don't trust other central banks. The South Korean central bank, for example, which is a loyal ally where the U.S. has, a lot of military presence right in South Korea, and they're even buying more gold right now. So I think we are in a situation of deep uncertainty. People have to protect themselves, but even central banks don't trust other central banks. They don't trust other nations. And so the preconditions are ripe for a hyperinflation, or at least more inflation to come.
Yeah, because back in 1923, during the German hyperinflation, the Reichsmark was not the major reserve currency. I don't think we've ever seen a major reserve currency hyperinflate. And usually, let's say I grew up in Brazil, and we use dollars if their local currency hyperinflated. We didn't use gold, but I think the central banks around the world, aside from trying to, let's say, diversify from the dollar as a political, because the U.S. has used the dollar as a political weapon, I think they can see the writing on the wall of the runaway deficits in spending. So they're loading up on gold. And I guess even though I'm not really a fan of central banks, I think in this instance they're right. And you mentioned that hyperinflation starts, it brews, it takes a long time to brew, but when it starts, it's like, it's almost like it's so quick that you can't even react to it if you haven't exchanged your fiat currency for anything that has value. Doesn't necessarily have to be gold and silver, but anything tangible and that allows you to survive. I think you're 1 day late. So I've been looking at these two charts for a while now, and I call it disturbing resemblance. And this is the Reichsmark back after World War One, and that's the price of 1 gold mark. And you can see that the price was going quite gradually and gradually. And then all of a sudden here in the summer of 1922, it just took off. And then by, I think, the end of 1923, the Reichsmark collapsed and they had to bring in a new currency. I think it was called the Rentenmark, and that was backed by gold. And even though this chart here on the right is the current day dollar price of gold, it's over a longer period, but it looks very similar. And I think it's really concerning. And I think we could be around here. What's your take on this?
Well, that's exactly the type of thing that I'm concerned about. And I've been a coin collector and silver stacker my entire life since I was about 9 years old. And I encourage, if you're on a fiat monetary system, I just think it's, I'm not a financial advisor, but I just think it makes sense that you would save your money, or at least a part of your money, in precious metals, securely someplace, because of the potential for this kind of thing. So you don't have to worry about that, because psychologically it's very, very difficult when people start seeing the family budget disintegrate before their very eyes. And, and so you need to be prepared in advance. The time to buy a fire extinguisher is not when the fire breaks out, but when you buy the house, or when you move into the house is the time to buy your fire extinguisher. And so that's always been my approach. And that's what I've always recommended to people, because of the situation and because of the psychological damaging effects, that impact people. And, in terms of the dollar, and you mentioned that, people in Brazil use dollars. Well, people around the world hold part of their savings in terms of dollars because they've experienced lots of inflation. Now, let's imagine a world where instead of just 1 year, we see a 10% fall in the value of the dollar versus the dollar index of other fiat currencies. But what happens if these other fiat currencies experiencing a loss of purchasing power, which is certainly possible with the British pound and the Japanese yen and the euro? And what if the dollar outpaces all of that, and people around the world want to repatriate their dollars back to the U.S. and pick up maybe silver or gold instead? And what happens, if people want to take their investments out of the U.S. dollars and U.S. stocks and repatriate them back into their local economies? And what happens if drug dealers who hold vast hordes of U.S. currency, if they want to get rid of all of that U.S. currency and get into gold, silver, or Bitcoin, or whatever? And what if that all happens in a short period of time because of what goes on in Washington, D.C., or what goes on at the Fed? What happens if the Fed goes back to a zero interest rate policy? What happens if the Fed decides that it needs to expand its balance sheet? They just said yesterday that they're going to stop the quantitative tightening, which of course we've all been expecting, and I've been expecting that they're going to go back into quantitative easing. They're going to try to squash down those long-term interest rates by the Fed buying long-term U.S. bonds and mortgage-backed securities and things of that nature, as well as just treasury bills. What if all that happens? Well, the value of the dollar is just going to start a cascade downwards. And so we don't know when that's going to happen. We don't know even if that's going to happen. But, in terms of my savings and other people's savings, I would rather want to be pre-prepared, with my fire extinguisher against government inflation, basically. I would not want to wait around and hope that the coin shop is opened, or that online dealers happen to have supplies on hand, because what we've seen, during the recent growing pains in the market for precious metals for retail buyers, is that they've experienced just the growing pains recently of the new high prices, that all of a sudden they may be just totally out of stock, or they may be charging, like the last time I checked, an online dealer, they wanted like it was like a 20% premium for the U.S. Silver Eagle. So, you want to take advantage of situations as they occur over time and be prepared for something. You don't want to try to react like some sort of machine trading robot on Wall Street, because you don't have that. You're not prepared to do that. So I would get pre-prepared for those contingencies.
Yeah, you said earlier in the interview that the mainstream press, they talk about gold only when it goes down, and the other thing that happens is that people that never cover gold, they come out of the woodwork to call it top, and they don't seem to understand how important gold and silver are in terms of a currency insurance, or like a fire extinguisher, as you said, and that is really well, it's worrying for that. It's worrying because I think they're going to be blindsided by what's coming. And I was going to ask you what you think could be the trigger, but of course it's difficult to say. But the other thing, Mark, that I've been covering, and you might have seen some of my videos about this, is that hyperinflation is not just like the currency losing value because the central bank and the government print and borrow too much, but it's also to do with the political climate in the country. And you were saying that you were at a conference recently, and you said that everything that's good comes from below, and right now everything that's bad comes with COVID and all the other crises is coming from above, and I think that's important because when people lose faith and confidence in their leaders, they'll lose faith and confidence in the currency that they issued. So, do you see that also as something that will weigh on the dollar?
Oh, absolutely. And I think, the general trigger that I think is worth considering, but there are many, and there are triggers for this as well, is a collapse in the U.S. stock market. It's the one bright, shining star in the world economy, the Magnificent Seven, and the AI revolution and all of that seems to be holding up the U.S. stock market and buoys markets around the world. And of course, it's created a lot of investment intensity in certain areas of the U.S. economy. So, people think, well, if that is doing so well, then things are probably okay. If we start, or when we start to see a breakdown in the U.S. stock market, and of course we know that Europeans have been investing heavily in the U.S. market in recent years, and they hold, a vast amount of investments in the U.S. economy. So I think if the U.S. stock market star starts to sink, and people start diversifying away from that, I think that's really the trigger. And I think you're right. I mean, people start to lose confidence, and the Fed is, of course, always playing a confidence game. They're always telling us things are great, things are good. They're looking out for our safety. They will come to the rescue. And so the people are being fed all of this confidence, to believe in the system, even though the system is clearly ripping off most people. basically. I mean, the people are not benefiting from this from the system, and it's really just a matter of enough people waking up to the fact that they're getting ripped off by the system, and then being able to identify who's doing the ripoff, because this is kind of like a shell game that the Fed plays with the spending and the deficits and the debt and the inflation and the Fed buying, government bonds and, bailing out people. It's all kind of a shell game, so it's hard to catch on. And that's where I think I'm optimistic, because I see so many people in my daily life who just disregarded everything I said when I was younger, that they just didn't believe, that Thornton's a crackpot, Thornton's an academic, Thornton is a, wide-eyed optimist or pessimist, both of those two things. And now they realize that, well, maybe I was right about a few things. And so people are catching on, and I think that's the optimistic message. But once a significant number of more people catch on to this game that is being played to their own detriment, and that's when I see the system hopefully reforming itself in the right direction. But even if it doesn't, even if we head down this road to hyperinflation, which I really hope we don't, because there's a lot of bad things that can happen under those circumstances, it's still going to mean that people are going to have to rebuild their economy, their local economy, from the ground up. And they're going to have to resort in hyperinflation to going back to gold and silver, to barter, to local communities, local economies, and things of that nature. So they're going to realize that the top-down solutions were there to their detriment and to the enrichment of the political elites. And their salvation did not come from those political elites, but their salvation came from their local circumstances, their friends, their family, their business associates. That's where the real solutions are going to ultimately come from.
Interesting. You talked about the Fed, and I listened to Jay Powell the other day, his press conference after the FOMC meeting. Not that I like listening to it, but I needed to see what he was saying. And he actually admitted that there's like two economies. There's the Wall Street and the EAI sector who are doing great. And he even said the bottom 50 is not doing well. So too bad none of the reporters asked him a question. Don't you think that's because of you, right? Because of the Fed, you help out Wall Street and the corporations, and the people get left with the currency that becomes worth less and less, which is what's the effect? I forgot the name now. He was a French economist back to
Cantillon.
Yeah, Cantillon Effect. The Cantillon Effect, yeah. So that the money, the people closest to the money spigot, they do really well, and by the time it gets to the bottom 50%, it's become worth less and less. One thing, though, I wanted you to explain, Mark, is because in that little piece of the human action that I brought up, von Mises, or in human action, he talks about the mathematical economists, or if you want to call it the PhD economists nowadays, who don't really consider human action. And I think that's one of the great things about the Austrian school. They look at how humans react. They don't just look at equations and numbers. And one of the books that really helped me was Fiat Money, Inflation in France by Andrew Dixon White. And I know he wasn't an Austrian, but what I learned from that book is once you start down the road of printing money, it's really hard to stop. So do you think this is where we are? when there is a crisis, and I think we could be near a crisis. I don't know what could trigger it. We could see the Fed print even more trillions on its balance sheet. So maybe you could explain to us the difference between the way Austrians think and Keynesians think.
Well, of course, the mathematical and Keynesian economists are thinking in macroeconomic terms rather than in microeconomic terms. From Cantillon's day, and I do a lot of my research on Richard Cantillon, and he was really the first theoretical economist and an Austrian in a sense. But this is part of the whole cover-up thing, where the Fed will say, well, we cut interest rates, that's going to help the little guy be able to buy a car or buy a house or reduce the credit card interest rate. But of course, that's not going to really help the little guy. You're just digging the little guy into more and more debt. What that really ends up helping is the banks, corporate America, the big guys, the political elites are the ones that benefit from those lower interest rates, even if they're on a temporary basis. So it doesn't help the little guy. It's what's led to the fact that the little guy has lots of debt, is burdened with excessive amounts of borrowing and credit card debt and so on. And this is that whole process has enriched, as Cantillon shows, it enriches the people who first get the money. And that's Washington, D.C., and it's the big banks. Those are the people who get the money. Those are the people who see their asset prices go up without the price of goods and services going up. By the time the little guy gets the money, everything's already been marked up. And so the idea that it helps the little guy in any way is just completely backwards. It just digs the holes for the little people, the consumers, the workers, that much deeper. Stopping the printing press is politically harmful. Mises says that's the only way to deal with the situation. And of course, politicians, they don't want that because the government is the biggest debtor of all. And of course, the political elites and the banks are the ones that are holding a great deal of that debt and are leveraging up their own investments based on that debt. And so when you break it down and you look at who's got the money, who gets the money, when do they get the money, you find that the process enriches the political elites and hurts the working class people out there in the economy. Now, if we stop the printing press, what that's going to cause is asset price deflation. If there's no more fuel going into those credit pipelines, then asset price deflation is going to take place. And that means stock prices, real estate prices, those are the things that are going to fall. It's going to put the government, like the U.S. government and other governments, it's going to put them in a position of defaulting or into hyperinflation, so that the pain is going to be at least started there at the government level, at the high level of the stock market and the high level of the real estate market. It's not going to really cause an end to toothpaste production, for example. It's not going to, end the production of Coca-Cola, things of that nature. That's all going to go on. Electricity is still going to flow, the pain is going to be felt throughout the entire system, but the most concentrated pain is going to occur right where we want it to, which is in government itself and the political elites that control Wall Street, that control the government, that control the vast swaths of the most expensive real estate in the economy, the skyscrapers and Wall Street and all the rest. So that's exactly the way I would prefer to deal out the pain, is to put it most heavily on those people who are responsible for creating this massive situation in the first place.
Yeah, Ron Paul, I met him back in 2002. My wife and I went to the 20th anniversary of the Mises Institute, and he was talking about how he got Alan Greenspan to autograph the article he wrote in the 60s called Golden Economic Freedom. And he asked Greenspan, "Do you still believe in that?" And he said, "Yes, 100%." And he said, unfortunately, the vast majority of people, they like the inflation, they like the government subsidies. So I guess if we did stop the printing press, it would hurt like the elites, but it would also hurt a lot of people that are dependent on government. What would be the way to like cushion that? I think Ron Paul, he spoke about doing it gradually, for example, so that the people, let's say seniors and people who still depend on the system, get some help.
Yeah, I mean, I'm not an expert in that area, and I fully agree with the idea that, we should have some buffers, multiple layers of buffers to support the people who were not part of the problem in the first place, were not responsible for creating this system in the first place, and that all of the pain should be dealt out to the people who benefited from the system and created the system, and have become massively wealthy as a result. So, and I don't think that the normal channels of the economy are going to completely dry up. So I don't think electricity is going to stop. I don't think food is going to stop. I don't think toothpaste is going to stop. And but Ron Paul is right that we have to be ready and able to support those that are otherwise completely dependent upon the government. And of course, we should be working for restoring people's independence right along. Everything we do, everything the government should be doing, should be working in the direction of restoring people's independence, like encouraging them to have gold and silver, like encouraging them to have safety, savings, especially of some sort, to have a job, to develop skills, to develop multiple skills in the workplace, so that you're capable of absorbing the tremendous changes that are going to be taking place, depending upon, of course, the types of reforms that we get and when we get them. But again, stopping the printing press is going to dole out the pain most heavily and most directly on the people who are responsible and who are best able to absorb those pains, the millionaires, the billionaires. And, we're fast approaching an era where we're going to have our first trillionaires. And these are people who are not only benefiting from the Fed, but are also benefiting from government contracts, whether that's Amazon or Google or Larry Ellison or Planeteer. All of those government contracts have to go away, and the government has to basically completely stop doing most of what it's doing, including, Social Security has to morph into a welfare program that helps out people who otherwise have no means of support, basically. In a national government bankruptcy situation, that's the general direction that things would have to take place. So just imagine the government going through a bankruptcy process and a prioritization of the remaining assets and income and expenditures. What has to go and what needs to stay. is a matter of priorities, is a matter of legal obligations, basically. But yeah, it's going to be painful. But even if you continue to print up money to pay for all these things, that does not reduce the overall pain. It just increases it and spreads it out over a longer period of time. And unfortunately, if we don't do something soon, we're highly damaging the current and future generations of economies around the world. People wonder, well, why aren't people having children? Why is the population, why is the working age population shrinking? Well, it's because this generation and previous generations have dumped an enormous amount of obligations onto the future. So if you're having children, you're birthing them into systems which place enormous burdens on them. And that's got to stop, or the entire race is at risk. And you see the demographic problems that are emerging, causing strange political reactions in Europe and the UK and the United States, even in China, Japan. So these have wide-ranging effects. It's not just your personal pocketbook issues. What the Fed has been doing, what central banks have been doing, what the fiat monetary system and this runaway government debt has been doing is really undermining the very basis of human civilization.
Yeah, no, I agree. And like you said, stopping the printing press and bringing the system down is actually not as bad as people think, in my opinion, because there will still be factories out there, there will still be real estate, and there will still be people. All you need to do is reorganize the monetary system into a fair and sound money system, I think. And if we keep printing and delaying things, we're just kicking the can down the road. So I agree with you 100% there.
All the physical capital is still going to be there. It's just a matter of who owns it moving forward. And we've seen with these hyperinflations that in the aftermath, people recover very quickly, especially if they're given a fundamentally sound monetary system and a free market economy. Just look at Germany and Japan after World War II. They had their capital all destroyed and their population wiped out, but they were given a free market economy, and they not only recovered, but they became two of the fastest growing economies in the world within the matter of just a decade or two. So recovery can be quick and swift and miraculous, really.
Yeah, it was the German economic miracle, Wirtschaftswunder. Dr. Thornton, it was great speaking with you. We should speak again. Let me know if you have something you want to talk about. And I love the Mises Institute. And I'm ready to talk to you again and other people there.
I really enjoyed it, Mario. And we have a book offer right now where you can get Hayek's greatest hits. So if you put your I want Hayek's greatest hits or just Hayek in the comments of this show, I'll send you the link where you can get a free copy, or actually free copies of this book. And Hayek was a great student of Ludwig von Mises. He won the Nobel Prize, and he was one of the main inflation fighters during the stagflation of the 1970s, and he was really the ideological backbone for Margaret Thatcher and for Ronald Reagan. And so I would encourage everybody to get a copy of this book.